Alright, so recently I was approached by someone to, they wanted me to create a spreadsheet for them that they could use to do back testing. Right? So they are into Forex trading. I am not into Forex trading, at least not yet. No, I had to learn a few things to put this spreadsheet together so they can use it as a backtesting tool. I also realized that there are other tools out there, but you could simply use an Excel spreadsheet to create a nice backtesting tool, and that is what I attempted to do here. The person who I created it for, they seem to be okay with it. It seemed to be very useful to them after I went through it with them and all of that. And I decided that, maybe other persons can possibly benefit from this. I see tools out there that are being sold. I see persons charging a lot of money, selling even their own spreadsheets. I just decided that, I could show persons this. And if it is something that you are interested in, then, we can make arrangements and I could get this to you. All right. So I'm not going to necessarily go through the formulas. I'm just going to show you what it does. And, I suspect that most persons who are watching this, you are into Forex trading and you are already familiar with some of the concepts that would go into backtesting, and you are already familiar with what backtesting is. Right? Now, based on my understanding though, backtesting is basically a way of assessing how viable your trading strategy is. So whatever trading strategy you decide to use, the backtesting will basically, look at how viable your trading strategy is. All right. Now, reading from a direct quote here of something I found in regards to backtesting, it states that backtesting assesses the viability of a trading strategy or pricing model by discovering how it would have played out retrospectively using historical data. So that is what we'll be entering. So if you notice, I have a time column and a date column. All right. Now, I'm going to demonstrate this by using 10 trades. All right. Now, here will be the currency pair that you are trading in. I'm going to use one of the more common currency trade, which is the Euro US dollar currency pair. Now, something I found out is that the currency pair is the quotation of two different currency, and you have one that is referred to as your base currency and the other one is referred to as your quote currency. All right, so as I said, I'll use the euro and US dollar as our currency pair here. All right, so I'm going to enter EUR/USD. Alright, I'm just going to copy this because I'm going to use the same thing for all 10 trades. Alright, so those are our currency pairs. Alright, the next thing I'm going to enter is a time and a date. Alright. And let me just copy these down. This is not important for me, but again, if you're going to do your actual backtesting, then you'll put in the actual time and the actual date. Alright, let me just give it some space. Alright, good to go. Alright, so a very important bit of data to enter here is your stop loss. Alright, and again, based on me doing my research to create this particular spreadsheet, I came to find out that your stop loss is also referred to as a stop order or a stop market order, and is basically used to limit your losses. All right, so A stop loss is an order type used in Forex trading designed to limit losses from a trade. So that is what I gathered from my little research that I had to do to create this little Excel tool here, right? So I do have some stop loss that I want to use. So I'm going to enter these now. And I'm also going to enter the values at a particular position. Now, I realize that even though I have position 1 and 2 here, all I need to do is just enter position 1 because, again, based on what I would have seen, it is not necessary to have a position 1 and position 2 value entered. Right? So again, the persons who are more into Forex trading, you can probably, help me out, give me some additional information. And but the point of this video is just to present this tool to you. If it is something that you're interested in, as I said, I can make it available to you. All right, so our first stop loss value will be 18. But just before I enter that stop loss value, now some of the data that was important to be captured is the win average. I used a formula to calculate the win average. Or the average win. I used a formula as well to calculate the average loss. I also used a formula to calculate the average return based on, or your average reward based on risk. So your risk reward ratio, I used a formula to calculate that as well. And this one was maybe the more straightforward one for me in terms of your average reward per risk, or your reward risk ratio. That is just dividing your average win based on your average loss, or dividing your average win by your average loss, right? Also captured the total pips and also the total trades, total wins, total losses, your winning percentage, your total dollar gain, your total percentage gain, your max drawdown, right? Standard will be your starting balance. So whatever you want the starting balance to be, you'll enter that. And whatever your risk percentage per position is, you'll also enter that, right? Right. Now, in terms of the PIP, I found out that PIP actually stands for percentage in point, or price interest point. All right, and again, based on my reading, a PIP is said to be the smallest whole unit price move that an exchange rate can make based on Forex market convention. All right, so your PIP is generally, price interest point, or your percentage in point. And what simplified my understanding of PIP, or at least what I understand so far, is the fact that I saw something where it says that PIP is the unit of measurement to express the change in value between two currencies. So, like I'm using the Euro USD currency pair, then I guess the PIP would be the measurement that expresses the change in value between those two currencies. And I, found as well that recording your drawdown per trade was important, and also recording what your max drawdown was important. So again, I used a function, or a formula if you want to call it that, to get what the drawdown would be, and also get what the max drawdown will be. And drawdown again was one of those that was more or less easy to understand, because the drawdown is said to be an indication of when you lose money on a trade. All right. So it is said that when you lose money on trades, you have what is known as a drawdown. So again, that was pretty straightforward for me, who is not a forex trader. All right, so yeah. Now, to put this whole drawdown thing in more detail now, I saw something where it says that when it comes to forex trading, drawdown refers to the difference between a high point in the balance of your trading account and the next low point of your account's balance. So the difference in your balance reflects lost capital due to losing trades. So the drawdown is the difference between your high balance and your next, or your high point and then your next low point. So that would be an indication of, okay, you would have lost such and such on a particular trade, or you'd have lost a given percentage on a particular trade. So, creating this actually is assisting me with, wanting to know, get into forex trading. And if I do, I think I'll definitely be using this Excel spreadsheet to do my back testing. All right, so let's simulate the 10 trades, and then, you can always comment and let me know if what I did here makes sense, if it looks like a tool that can be used. And as I said, if it is, then, going forward, once I get into forex trading, I'll definitely be using this for my back testing. Right? So let's go with 18 as our first stop loss value. All right, and for this trade, for position 1, let's say it was 26. All right, so this would reflect a gain. And remember, the risk percentage per position is 2%. All right. All right, so just to show this again in terms of how everything works, and I'll be doing this for 9 other trades, so you will see the trend or the pattern in terms of what is going on. So 16 is my stop loss for the second trade, and I would have lost 16, so that's a negative 16. The loss is reflected here. So we have 2 trades now, a total of 2 trades, 1 win, 1 loss. All right, my average win is the only win that is reflected here in our dollar per trade value, and we have the average loss, which is this only loss that we have here. All right, my drawdown is shown as negative 2%. My current percentage gain loss is 0.83%, which is also reflected as the total percentage gain, and my max drawdown is our current drawdown here of negative 2%. Right? So my third trade, I'm going to put a stop loss value of 20, and for this position it's a loss of minus 20. So that's another loss, and I was mindful in terms of distinguishing when it's a loss versus when it's a gain. So if it's a loss, then that is reflected in red. All right, so it's reflected in red here. Our total pips is negative 10 so far, right? So let's do our fourth trade. I'm going to go with 22 at the stop loss and a positive 31. So that would be a win for us. So we end up gaining $278.48 here. Our total pips is back up to being 21, so it's back on the positive side. Our account cash went back up for this fourth trade, so it went down for the second and the third trade, and it's back up now when compared to the fourth trade is back up when compared to the third trade. All right. For fifth trade, I'm going to go with 22 as a stop loss, 31 again. All right, so that is reflected as a win. Again, we gain. Our max drawdown is negative 3.96%. Right. Our total gain percent is 4.46. We currently have 5 trades, 3 being wins, 2 being losses. Right, so this is good for, basically summarizing your trade as you go through the different trades. All right, let me go with my 6th trade being 20 for the stop loss value, and then negative 20, so we lost. All right, so at position 1 we lost. All right, and let me just enter the other 4. So I'm going to go with 22 again as a stop loss, 31 for our position here. All right, that should have been a win for us. All right, yes it is. It is a win here. All right, because we gained on it. All right, and then our 8th trade now. Let's go with 23 as a stop loss. And let's just say we have a minus or a negative 23. Say we have a negative 23. Alright, so that would be our loss. And then for the 9th trade, let's go with 22 as a stop loss, and then 31, which means that this will be a gain here. That's a positive 31. Right, and then for the final trade, the 10th one, let's say 25 as a stop loss, and then 36. Right, now based on my research, I found that up to 100 trades should be good enough when you are doing your back testing. All right, now this is my little simulation here with my 10 trades. If you realize, it worked out my average win for me. So that's the average of all my wins. My average losses were calculated as well. My risk to reward ratio, or my reward to risk ratio, that was calculated. My total pips, that was calculated. Total number of trades, just in case I want a quick summary of everything. My total wins is 6. My total losses is 4, which means that my winning percentage would be 60%. So basically, whatever strategy I am using, I am winning 60% of the time, which 10% more than 50%. So again, being a non-Forex trader, I think this is okay. But again, the Forex traders can let me know. Alright, my max drawdown is reflected here as well. So again, as I said, you can let me know if this is a tool that could be useful in your forex trading. If it would be something useful in your arsenal as you go about to be the best forex trader you can. And definitely, doing this sort of practical thing, and doing the research just to put this spreadsheet together, I am definitely interested in getting into forex trading. So yeah, so let me know what you think about this, and also let me know if it's something that you would want me to provide you with. All right.